Hello, everyone, and welcome to Coffee Talk presented by Affirmative Technologies. Our discussion today will be on treating your best payments clients like VIPs. But the main question becomes, how do you know who are your best clients? And here to discuss that question is Kim Ellis from UMACHA, where she is a Senior Director of Member Services. She has triple NACHA certification as an AAP, AFPP, and APRP, of which she is very proud, and rightfully so, and is a seasoned banking professional. Kim uses her experience to educate UMACHA members with payment-related advice, building their knowledge and their confidence. UMACHA is a nonprofit association that serves financial institutions with assistance on ACH information, compliance, and training. So they're a go-to resource for payments and AC knowledge for the financial institution industry. We have James Rowe, who is a CEO of Affirmative Technologies and a member of the ownership team as well. James is a data scientist and an adept problem solver. He has past executive roles at both FIS and at Capital One. And I'm your host, Rob Dorsett, and I'm an account executive at Affirmative. And so hopefully you all have your hot cup ready. And with that, we'll get started. So to start with, many financial institutions apply uniform pre-funding or review rules to all clients. So where does a one-size-fits-all approach create friction for your best treasury clients, as opposed to being able to use data to treat your best ones better?
Sure. So thanks, Rob. I'll start with this one. And really, if we do a one size fits all approach, we're not meeting the needs of our clients very well. We may have very large clients that pre-funding is not an issue for them, or having dual control, not an issue for them. But think about some of your other clients that maybe are smaller. Maybe it's a mom and pop shop and they just don't have the liquidity for that pre-funding, or they don't have the ability to do some of those additional controls. They don't necessarily understand the need for that, and it's just not appropriate for the risk that they present to the organization. So really, if we use a one size fits all, this is one of those situations where it doesn't work as well as digging into the data and figuring out what is appropriate, what is the risk level presented by this organization or this originator, and then adapting our controls to fit. So James, I'll let you add your thoughts to that.
Yeah, sure. And Kim, I just want to say on behalf of Affirmative and Rob and myself that we're certainly delighted to have you join us today, and we really appreciate it. I'll tell you, I'm going to tell you a story about why I got involved with Affirmative. I've been a member of the ownership team back since like late 2018. It's flown by, only feels like a very short period of time. Although I didn't have a gray beard when I started in this particular job. In my younger days, I worked for a company called Capital One, and this was in the 90s, early to mid 90s. And at that time, Capital One was a fledgling credit card company that just spun out from Signet Bank. And the vision behind Capital One was this: the credit card industry, up until that period of time, was one size fits all. Many of you will remember APR was 19.8%. It was a very high credit standard to get a credit card. Credit limits were the same. There were no unique features associated with credit card accounts. There's no balance transfers, no teaser rates, no rewards programs. Capital One saw that as an opportunity to innovate the credit card industry by treating every customer uniquely based on their own data and their own performance. Now, we called it at that time the information-based strategy, using data to be able to differentiate which were the low risk customers, which were the high risk customers, who was going to respond to this offer, who was going to respond to that offer. And Capital One and MBNA was another firm of the really, those were the two credit card companies that completely revolutionized the credit card industry. I really view treasury services. And one of the, I think, great opportunities that we have in this industry, and we're trying to champion really at Affirmative, is to think about treasury services today as an opportunity to start to differentiate based on data, to treat each treasury services client uniquely according to their own needs and their own risk. And in order to be able to do that, you've got to be able to understand them uniquely. You've got to be able to access, which is one of the things we help with at Affirmative, access data on originators, organize it properly, and be able to understand it. So what we are really providing the industry with the opportunity to do, and what we think is will be a huge impact on the industry, and we'll talk a little bit about why in subsequent questions, is to be able to treat every treasury services client different. Today, they're all treated the same for the most part or very similarly. Financial institutions are fairly conservative in how they set limits, how they require pre-funding, funds availability policies. If you can really identify the customers who are good, you can release or you can relax those requirements, which makes for a much better experience for those typically commercial clients. And that actually is not only going to make them happier, it's going to bring more of those clients into your financial institution. So we need to move away in this industry. Our view and our vision is to try to move away from a one size fits all approach and to help our clients be able to do that.
Yeah, totally understand that. I think we all do. So that's fantastic. And so Kim, what size financial institutions and treasury programs do you think would benefit from this more data-driven approach?
Really, I think any size program can benefit, right? I came from an institution that had a very small ACH origination program. We had about 20 to 25 originators, and I tracked everything manually. It worked, but I think having a solution that could give me the data that I didn't have to go pull all those pieces myself would have been hugely beneficial. And then I think about the other side of the coin where you have those very large origination programs, thousands of originators. They can absolutely use this because they don't have the time to dig in like I did manually.
Hmm. Yeah, no, absolutely. Well, what kind of tools were you using when you were having to pull all that information yourself?
Sure. So a lot of it was reports, whether it was reports from Fed Reporter showing me like the number of returns, the number of originated items, also looking at reports from our core, looking at account histories, that kind of thing, right? So it was very manual for me to go out and do that. But again, it was 20 or so originators. I could handle doing that. Whereas if I had a larger program, it definitely would have been too cumbersome.
Right. Yes. So the importance is getting that information not only accurate, but quickly.
And I would say I think that's a big challenge. I mean, every size financial institution has its own unique challenge in being able to even access its own data. I'm sure Kim would agree with this. And what we find very consistently, across our clients, regardless of the asset size of the financial institution, is that larger clients, they may have more IT resources, but they typically are working on other projects. It's a significant cost allocation. You may have to try to go to your core, which, having worked at FIS, I know that the cores can take a while to accommodate these types of requests just to get your own data. And it can also be very expensive to do that. And then the smaller financial institutions, credit unions, community banks, they may not even have the expertise or the resources internally to be able to facilitate that and still have the issues associated with getting data from their own core. So one of the things that we do to help alleviate that in terms of accessing this historical data, remember to be able to move away from a one size fits all approach in terms of how you treat your clients, is you've really got to be able to get the data on your clients and store it and manipulate it and use it and report on it in a useful way. One of the ways that we are able to accommodate that is to go to the Federal Reserve. We get a connection with them and we download the data, so we bypass the need for the core, and that makes it a much easier proposition to be able to access that historical data. But that really is the biggest lock in the or impediment to being able to take a unique information-based strategy in managing your treasury services clients. It's just getting access to that data.
Yes, yeah, absolutely. So that's really great insight. And Kim, did you have anything more you wanted to add?
No, nothing else on this one. Thank you.
Okay, yeah, no problem. Okay, we'll go on to another question here. So once you can see real originator behavior, how do teams decide who deserves less oversight and where scrutiny should actually increase? And I'll
Yeah, and
start with you, Kim.
yeah, I
Yeah.
think this one's going to start as many of our things do when we're trying to figure out what do we do next or what controls we apply. We're going to do a risk assessment. So we're going to start out with a risk assessment, looking at our originators, whether that is individually or maybe we're going to group them together by industry type or by other characteristics to help us do this. But really figuring out what does our originator pose as a threat, and then that's going to decide where do we need to have more oversight, where do we need to have less oversight. So things we've talked about, pre-funding, right? So which types of originators are we more likely to see that loss where we want to have them do some pre-funding, or which ones on the other side of that are less likely to leave us in a loss position, and we're okay giving them the flexibility to not pre-fund those entries. That gives them that liquidity that they can use up until settlement date, whereas if we're requiring pre-funding, we're going to want that money a couple of days earlier.
Hmm.
Other things we might look at are like the limits, right? So setting our limits. We don't want to have an across the board. This is our exposure limit for every single originator. This is their daily limit. This is our monthly limit. That's not right. That's not appropriate. That small mom and pop shop that's paying payroll to 2 employees has a very different need for an exposure limit than a large manufacturing company that is using ACH to do their accounts payable and their accounts receivable. So we need to take that into effect. And then also, again, going back to our risk assessment, figuring out what risk does this originator propose to our institution, and then how do we mitigate that? And then that can help us figure out where we need to have more oversight, where we need to have less oversight.
Yeah, Kim certainly is our expert on the unique ways in which risk is managed and how those risk assessments are done. What I can share from our experience with our clients and having done some of the predictive analytics that we deploy through our platform is that a lot of times financial institutions, because they lack data on originator performance, discrete data, like detailed historical information about whether or not they've had unauthorized, how many unauthorized transactions, what are the trends associated with that, what are the other variables associated with their origination activity through the financial institution. They tend to design their originator review programs. And of course, the originator review program, as I see it, is really the basis for making a lot of this, moving a lot of the specific risk levers that Kim mentioned in terms of limits and pre-funding. And it's originator review programs designed, and it's designed really, it tends to be designed to focus on areas that aren't directly related to the originator's performance with that financial institution in terms of unauthorized activity. And the reason is that that data isn't available typically to make that specific assessment. So in other words, they'll get a profit and loss statement from the business, or they'll look at credit relationships that the business has with the financial institution, and they'll design, a set of criteria to make this originator risk review for all their originators, which they have to do according to NACHA requirements and is good business practice. They do that for everybody the same way, and they use criteria that isn't necessarily directly related to the risk that originator is going to submit unauthorized activity. And that really is, in my view at least, the key risk that Treasury Services faces when it has an originator as a client is what is the risk of unauthorized activity. That's fundamentally it's the key risk to the bank economically through Treasury Services, and it's also what NACHA requires to be carefully managed. And so one of the ways in which we've helped our clients do that over the last couple of years is develop predictive analytics, basically a FICO score for originators that's based on the actual originator unauthorized activity and other factors. And we calculate a FICO score each month based on that originator's recent activity. And that score we translate into a risk grade of high, medium, or low. it will identify the likelihood that that originator is going to have unauthorized activity in the near term, in the next 30 or 60 days. And so that allows that first, that should, in our view, become a part, if not a key part, of an originator review program that every financial institution has. What is the risk of unauthorized activity as defined by that originator's historical activity, and be able to quantify it? A, you can use it to prioritize your originator reviews, and B, you can really get a better idea of a better ability to differentiate risk across originators and treat them according to their actual risk to the financial institution. So it's the tools to be able to do that that puts you in a position to decide who to give more relaxed limit requirements or pre-funding requirements, for example, to. It's using data on that originator's actual activity as opposed to a proximity of sources that the financial institution happens to have.
Yeah, absolutely. And actually, that kind of goes right into our next question here. What becomes possible when limits and pricing and reviews are based on performance instead of policy? How does that make for a better bank and growing revenue, Kim?
Yeah, it really gives the ability to customize, right? So we can customize those limits based on what's appropriate for that particular originator, but we can also customize it based on the risk that they pose to our institution. And pricing and reviews can go along with that as well. So, we've always kind of had this standard pricing, ACH origination cost is this, whatever your institution uses to do that. And there's nothing that says you can't offer some kind of incentives or you can't offer different pricing based on those relationships. Now, you want to make sure that you have some consistency and you have a method for determining that so that you're not, treating folks unfairly. But if you are looking at that relationship as a whole and factoring in their risk to your institution or their lack of risk to your institution, you can use that and offer them perhaps better pricing so that they can use your ACH services, and make them, more loyal to your institution. You're adding that value to the relationship. Maybe they're going to look at other additional services with you because of that relationship that they have based on the treasury client. The other thing would be the review. The review it's probably not fun for anybody, right? To know that you're having that review. And so just to let that client know, we're going to look at you every other year, or we're going to look at you every 3 years, because we know that we have a good relationship. We know that we have this sort of risk with you and it's being mitigated well. So we're comfortable with, instead of looking at you annually, we're going to look at you biannually or every 3 years. And I think that's going to make more flexibility for your staff, more flexibility for your clients. And I think just everybody is happier all around. James, I'll turn it over to you.
Well, I'll ask you a question. And you have a lot of experience in working with your, client base, and over the years. Do you see is there a view in those clients that treasury services, there's sort of this compliance need, right? But do you see these financial institutions, these treasury services groups, seeing themselves as a revenue generating aspect of the financial institution? In other words, is there a motivation for them to say, hey, if we can treat customers appropriately, and that means identifying the high risk customers as well as identifying the low risk customers, being able to segment those, we can serve each of those better. And that means we can draw more of those customers into the bank, more low risk customers, if that's the profile we want to serve, and even more high risk customers at the higher pricing that you mentioned. Do you see that motivation in your clients? Has it changed over the years, or do you still see it as like as a somewhat undiscovered opportunity?
I think it's the latter, right? It's an undiscovered opportunity. I think a lot of us have this kind of, this is how it's always been and it's how it's always going to be. And so we're maybe afraid to step back and see what else we could do. And I think you're right. Looking at bringing in more low risk clients, and we have a lower price point that's attractive to them, right? We could bring that business in and grow our services that way. But also on the other side, we could bring in some of those higher risk ones that are at a higher price point, but we've got controls in place, right? We've got mitigating steps to help bring that risk down to an acceptable level. So I think you're exactly right. I think that's something that could be a growth area for a lot of institutions, if we would step back and think about, having our program be a little bit more dynamic and base it on the needs and the risk profile of our customer or our client, rather than just this is what we've always done and this is what we're always going to do.
So, so that's interesting, and I think encouraging for our vision that there's an opportunity that's out there. It's hard sometimes to facilitate change in banking. That's just the way, that's the way it is, and that's okay. Um, it takes a while, but like I think the key is if you first, what we found across just about all of our financial institutions, very similar story. 98% of originators virtually don't have unauthorized activity. There are less than 2%, and you'd be amazed at how consistent this finding. Less than 2% account for over 80% of unauthorized activity on a regular basis. So if you can accurately identify those 2% of high risk originators. Now, it'd be higher than 2%. Some of our clients specialize in high risk originators. Some avoid them to the extent they can identify them. But on average, it's roughly 2% of originators would be high risk. It's actually a very small number. And if you can identify those, just being able to identify them gives you this power. First, your pricing, you can price it appropriately. And high risk originators, we do have some clients that focus on higher risk originators, relatively speaking, and they generate more revenue, right? You can charge higher prices, and that can be a very legitimate business strategy if you're powerful enough with your understanding of the data and the clients to be able to manage risk effectively. So that's a tremendous opportunity. Now, if you try to treat the other 98% like that 2%, you're gonna have adverse selection, right? The pricing and the restrictions that you have on the 98% are going to lead them to be open to other banking relationships. And I really believe firmly that the treasury services it's the handshake in a commercial banking relationship. If you, every business, Affirmative included, if we can't, we require our financial institution to provide us with liquidity to run our business. And if that financial institution makes it harder for us to get that liquidity, we're going to be open to other relationships. And then we move our investment relationships, our lending relationships, all the other areas that are periphery to that fundamental handshake with the financial institution, we're open to moving them somewhere else. So treasury services, if they can identify that 98% of low risk clients, they can treat them appropriately. They're going to bring in more of those clients to the bank because they're going to be driven away from other financial institutions that don't have the competitive advantage that this data or this insight gives them. And they can offer a more, not just more attractive pricing, but actually more importantly, more relaxed limits, more accommodative features of the relationship that give that business more liquidity. That in our banking relationship at Affirmative, we've got what we view are like unreasonably high requirements for pre-funding and other things, and if we knew we could go find another financial institution that could treat us, and I hear this from my entrepreneur colleagues all the time in their banking relationships, they would move. And so I think financial institutions can begin to see this as a competitive advantage through treasury services to effectively discriminate, so to speak, between low risk and high risk customers and treat each appropriately. It gives you power over both of those segments to be able to grow your business.
Yeah, and I'll just add, one of the things the ACH network touts itself on is being able for institutions to do these value added services. So not only are you building the relationship with that client through your deposit account, through your lending relationship, all of those pieces, but being able to offer those treasury services to say, here's how you can pay your employees, here's how you can pay your accounts payables and receive your accounts receivables all through the ACH network. It just gives that much more loyalty and that much more incentive for that customer and that client to stick around with your institution and build that relationship, make it even deeper. So I would absolutely agree that treasury services is a great way for institutions to build that loyalty.
And it all starts with the data. I go back to my Capital One example that I opened with. The difference between Capital One and other financial institutions was at Capital One, they called it information-based strategy. What that means is they started to get consumer data from the credit bureau until they became a Capital One customer, but then the actual usage of the credit card and other things. And they were much better at analyzing and modeling and predicting behavior than other more traditional banks that had a subjective view of what their policies needed to be. And as a result, those banks lost out market share to Capital One and other firms that started to adopt that data-driven strategy. And so I think we stand on the cusp of that in this industry today with treasury services groups that are willing to harness, organize, and properly leverage the data and analytics for the performance of the originators that are in their portfolio. Because I don't think I think that it may be done today. I don't think it's done enough to create a competitive advantage. And there's certainly the opportunity to do that.
Yeah, absolutely. Just really quickly, both of you have really touched on how there's so many pragmatic reasons that it can make a difference in the relationships with local businesses. But also local businesses really make a lot of their decisions based on emotions too. I mean, how does giving better terms and less reviews and treating them better, how does that make them feel about their relationship with the bank?
Yeah, I think that's a really great point. And, coming from a fairly small town, that word travels fast, right? Our businesses, they talk to each other. They're in service clubs together or they meet for coffee once in a while. They bounce those ideas off of each other. And so if they, hear that an institution is treating that somebody well, I think that's going to be an incentive to look into that other institution. James, you had mentioned if we could get a decent deal at another institution, we might think about switching. So if you had coffee with a colleague that was doing something and mentioned that they were getting a really great deal on their treasury services, that might be the incentive for you to reach out and start that conversation with the institution to see about moving your relationships there.
Yeah, and every institution and that I have come across is it truly wants to be relationship driven. It isn't just lip service. Credit unions, for example, that community. It focuses more on unique types of relationships or maybe specialized relationships. But community banks, regional banks. I think that all of these groups, and we have we have a lot of credit unions that come to us and they say, well, how do we get insight? Because we don't have a lot of data. We may be relatively small in asset size. We make up for that in relationship, but we don't have a lot of data that we can use to properly identify risk or historical performance. And that's why being a part of a consortium where we leverage this analytic understanding across our entire network of transactions over as about $1.5 trillion last year in transaction volume coming through our platform. And we don't share any data, but we are able to harness the understanding and leverage all of that data for the benefit of each of our clients, like a credit bureau does in terms of building a FICO score, understanding what represents a high risk profile. And so, there are lots of ways. If you're focused on relationships, you're a little bit maybe smaller in terms of asset size, or you don't have a lot of origination activity. There are ways you can get to become a part of a network like Affirmative is building and leverage that data for the benefit of creating that better understanding and strengthening those relationships over time.
Yeah, absolutely. Well, unfortunately, it looks like we could probably keep talking about this, but we are coming to the end of our 30 minutes here. So I did want to thank you, Kim and James, as well as UMACHA for making Kim available. If you would like to learn more about UMACHA as well as Affirmative, you can scan the QR codes on your screen, and we'll also follow up with an email with links to both services. And maybe most importantly, for those attending the NACHA Smarter, Faster Payments Conference in San Diego, we're offering a sunset catamaran cruise in the San Diego Harbor. And you can enter to win 2 tickets by scanning the QR code on the right. And this is going to be a lot of fun, guys. So if you're going, I highly recommend going ahead and scanning that and putting in your name on it. All right. Well, thank you, Kim. Thank you, James. Much appreciated. I thank you all for joining us today, and we'll see you next month for our coffee talk. Our topic is going to be breaking free from the bottlenecks that limit ACH growth. Thank you, guys.
Thanks, guys. See you.
Thank you. Bye.